Okay, welcome back. Now that we're looking at producer surplus with lots of sellers and a smooth supply curve, right? We've looked at the step supply curves before. We're considering the case for shoes. At a price of $40, what would be the producer surplus? Well, intuitively, right, before we even get into any of the slide, you have this whole group of thousands and thousands of sellers. They're all willing to sell the product. They're going to get a price of $40 if that's the price in the market. How much producer surplus will they receive? Well, it's going to be the difference between what they are willing to sell it for and what they get to sell it for. Right? You have some sellers who are willing to sell it for 20 or less. All of them are going to get $20 or more of producer surplus. If you sell at 15,000, like the 15,000th customer, the marginal seller's cost is $30, or willingness to sell is for $30. So that particular person, the person who's willing to sell for $30, gets a producer surplus of $10. Overall, the producer surplus is simply this area, right? The shaded area under the price, but above the supply curve. So you have some sellers who are barely receiving any producer surplus. They still find it profitable to sell, but they're not making that much in surplus. Others are making enormous amounts in surplus. So how do we measure this? 1/2 times the base times the height. The height here, 40 is the highest point, 15 is the lowest point, so $25. The base is just the quantity of 25. So 25 times 25, 625, divided by 2, 312.50. That is our producer surplus for this particular example. Now, if price drops, there's two ways that we lose some producer surplus, right? First, the overall producer surplus falls to 112.50. The height is now 15, the base is 15. 1/2 times 15 times 15, $100, $112.50. It's now this yellow triangle. It means the pink triangle is the lost producer surplus, right? This was value that the sellers were getting before. They're not receiving anymore. You could think of it as their profit as well. So what caused that drop in producer surplus? Well, part of it was that some sellers aren't selling anymore, right? You had a group here. You had 25,000 selling before, now you only have 15,000. This triangle represents the number of sellers who are out of the market. But then you also have every other person who was selling before and still is selling now, used to be able to sell their product for $40 each. Now they can only sell their product for $30 each, right? Every single one of those sellers is losing $10. So the fall in producer surplus due to the remaining sellers getting the lower price, $10 each, that accounts for the remainder of the loss. If you combine consumer and producer surplus together, this is called total surplus. Right? Consumer surplus is the value consumers get, right? The welfare for consumers. How happy are they with the outcome in the market? Producer surplus, it's the value producers get. The sum of this is called total surplus. And this might sound crazy, maybe for some of you this would be incredibly obvious, but total surplus is good, right? We want a lot of total surplus. You want buyers to be happy with the price they're paying, thinking they're getting a great deal. You want sellers to be thrilled with the price they're selling it for, that they're getting a good deal. So total surplus is a really good thing. Markets that are unrestricted maximize total surplus. I don't know that maximizing total surplus is necessarily the way you would want an economy to go. Like if you're looking at a decision on what would be best, would it be maximizing total surplus? It might not be, but it might be, right? I mean, it is a really good thing, this total surplus. It's the value everybody feels, like the total amount of gain these individuals feel from the trade. To maximize that means you've maximized the total dollar amount of the value that buyers and sellers are feeling because of the transactions they make. Well, markets that aren't restricted maximize total surplus. I put a little star by that. Usually. We're going to learn soon of what are called market failures. There are times when there would be side effects. When that happens, unrestricted markets won't maximize total surplus. But without the side effects, without these what you'll learn of as called externalities, unrestricted markets maximize total surplus. So it's a really good thing. I'm going to take a step away from total surplus now to move into price ceilings and price floors. So we're moving away from surplus now for a little while. We will be coming back to it. And we're going to talk about how the government tries to interfere with the market and how they may try to interfere with the market. And we start with price ceilings and price floors. So what are price ceilings and floors? Well, price ceiling, it's an imposed maximum price that the government says anybody can pay for a product. It would be illegal for a transaction to occur above that price. One example of that's rent control. A price floor is a legal minimum price that one can pay for a product. So the government says it would be illegal. It will be illegal to sell the product for anything less. One example of that would be minimum wages. When you have these price ceilings or price floors, they cause what are called disequilibrium prices. So the market, as we know, converges towards the equilibrium. And if the market's not restricted, right? If you, for whatever reason, seem to start at a price that's too high, there will be the market forces that push you down towards the equilibrium price. If you start at a price that's too low, forces will push you up towards the equilibrium price. What these price ceilings and price floors do is they make it illegal to get to the equilibrium price. So you're at a disequilibrium price most of the time. I'll explain when you wouldn't be. But at a disequilibrium price, the quantity exchanged is determined by the lesser of the quantity demanded and quantity supplied. Right? So if you're at a market and the product's selling for $5 and you impose a maximum price of $3, right? Consumers are going to think, what a great deal, and they will want to buy more. But sellers won't think it's such a good deal, and they will want to sell less. Right? At a disequilibrium price, sellers want to sell less, buyers want to buy more. Sellers aren't going to sell more, though. So the quantity exchange is going to be determined by the amount that sellers will provide, the lesser of the two. The same is going to hold if you have an opposite, a price above equilibrium that is determined, mandated by the government, a price floor. If $5 is the price and the government says, oh, it has to be 7 or more, well, sellers will think, what a great deal, and they will want to sell quite a bit more. But buyers are not going to think it's a good deal at all, right? The price is above the equilibrium. It's gone from 5 to 7. They will want to buy less. It's going to be the lesser of the two. We don't force the buyers to buy it at the price they don't want to purchase it for. We'd force them to buy it for that price, right? That's what the government can do, but they don't mandate that buyers buy a certain amount, just the minimum price. So we look at price ceilings first. And the first thing to note, where I mentioned you won't have a disequilibrium price if the price ceiling is irrelevant. When is the price ceiling irrelevant? Well, anytime a price ceiling is greater than the market price. Anytime the price ceiling is greater than the market price, it won't matter. So intuitively, or just logically, let's think through what this means. The government imposes a maximum price that can be charged for a product. In Selinsgrove, Pennsylvania, for instance, what if the government came in and said, for all one-bedroom apartments, you may not charge more than $1,000 a month in rent? Right? That's a price ceiling. The government is imposing a maximum price. However, I don't think there's a single apartment in Selinsgrove that rents for more than $1,000. That's a one-bedroom apartment, right? There's just not one. Now, if you're in New York City, this would matter, but not in Selinsgrove. That's irrelevant. And when we say it's irrelevant, what does that mean for our demand and supply? Well, it means literally it's irrelevant. Everything that happened before is going to happen now. There will be no harm. There will be no benefits. It's the exact same outcome. Anytime a price ceiling is above the market price, that's what you would see happen. That's not, there's no real need for us to do this analysis if that's the case. There are times where price ceilings are binding, and if we're talking about rent control, a $1,000 cap in New York City or in a lot of places would be binding. It'd be relevant. It'd matter, right? There are some places where if you have a $1,000 price ceiling, that's going to affect what the rent is. So let's look at an example then. Market for apartments. Price on the y-axis, quantity on the x-axis. And this is rental price for apartments and quantity. And suppose that in an unrestricted market, we have the price at $800 and an exchange of $300. So that's our equilibrium without price controls. What happens when price controls get put into place? Well, case here, what happens if the government puts in a $1,000 price ceiling? Take a moment, and I want you to try to figure out how would this affect the market. Why don't you go ahead and pause it just for a moment, try to figure out how does this affect the market. Okay, I hope you paused it, spent a minute thinking through this, and I hope you came to the conclusion that this wouldn't matter, right? This is like the case we just talked about. If the rent price is lower than the price ceiling, or the equilibrium, doesn't matter, right? The equilibrium was saying apartments are $800. Now the government comes in and says, whoa, nobody can charge more than $1,000. Well, nobody was charging more than $1,000, so this doesn't matter at all. This is not binding. It has no effect on the market. Any price ceiling that's above the equilibrium price will have no effect on the market outcome. So what about the case, though, of 500, right? This is the case that is going to matter. The equilibrium price above $800 would be illegal because it's above the price ceiling. So this was what we call a binding constraint on the price. It will cause a shortage. Why will it cause a shortage? Well, if you go from 800 to 500, the demand increases, right? Quantity demanded goes from our initial equilibrium and it expands outward, but the quantity supplied decreases. And in here we put some numbers in. We can actually even quantify this shortage, right? Now 400 apartments will be demanded, but only 250 will be supplied. We end up with a shortage because of the price ceiling. They show in the long run, demand and supply might be a little bit more price sensitive, right? If you have an apartment, if you own an apartment building, and the government comes in today and says, next year you can't charge more than whatever price it is. Most apartments are still going to be on the market next year, right? They're already built. But when some apartments get old and would need to be replaced, if the price is lower, people, the suppliers won't do it. They won't replace it anymore. It's not as profitable to run an apartment, so they'll invest in something else. So you'd expect more price elastic supply curve, probably a more price elastic demand curve as well, right? Price in the short run, if the city you're in changes the price, it's tough to move in the short term. It's not quite as difficult to move in the long run. So the shortage would be larger over time. If you recall from the Principles of in the Principles of Economics chapter, what do economists agree on? One of the things that's overwhelming consensus among economists is the answer that price ceilings in rent or in the housing market, which is called rent control, leads to shortages in the quality and quantity of available housing. It's one, I think it might even be number one on the list. Economists everywhere, left and right, all agree on that fact. I think there was like 7% who said no, and in any survey, there's going to be like 10% of the people who just goof off, right? That's kind of universal if there's no monetary incentives tied to the survey. Every survey has some people who are going to goof off and answer something. So if you get 93%, it basically means every economist. everywhere recognizes this as a fact. So price ceilings or rent control that you see in a lot of places like New York City and San Francisco, many other big cities, New York City and San Francisco are two that are egregious and really good examples. If you have any familiarity with those areas, you'll know the housing market there is a total, complete mess. Well, they've had rent control for a long time. Decreases the incentive to build new places, right? It's not as profitable. These firms want to make money. You can't make as much money. They won't build as much. It's going to lead to the shortage in quality and the quality of housing and the quantity of housing. So when you have something like rent control or any price ceiling, sellers must figure out a way to ration the goods among buyers, right? Those who are still willing to sell have more than enough buyers. What are some rationing mechanisms? Like, how would it be rationed? Long lines. It's one way. I mean, people could wait in lines, which is not efficient. Discrimination towards the seller's bias. So we know, I mean, these could often be unfair. Now, unfair is a normative concept, right? We never test on anything that's normative, so unfair is a bit of a normative concept, but you could go to somebody who's got political preference. It could go to somebody the seller likes. I mean, if you have people who are racist or sexist, right? So we'll learn later if an unrestricted market punishes discrimination. But if you've got all sorts of extra buyers, somebody who's racist or sexist could exercise their racism and sexism without any adverse monetary impact. And in short, the goods likely won't go to the people who value them most highly. To contrast that, if the prices aren't controlled, the rationing mechanism's efficient, right? We talked about maximizing total surplus. The people who most want the product get the product. So price ceilings do certainly have some negative consequences. When, we talked about the shortage, it's worth noting, of course, that the price will drop, right? If price ceiling that binding is imposed, the price did drop. It dropped from 800 to 500. The quantity dropped as well, so there's a shortage. Who wins and who loses when a price ceiling is imposed? I want you to pause and take a moment and think who's better off and who's worse off when a price ceiling is imposed. So go ahead and pause it now, and then we'll talk about it in just a moment. Okay, I hope you paused it to think through, tried to write out your answers for who you think wins and loses. So we go through this example. Let's going back to the example here we have from the rent control. Who wins and who loses? Well, what about consumers? Well, the price drops from 800 to 500. So does that mean consumers win? Well, if we just say consumers win, that's not right. But a lot of consumers do win, right? Anybody who still gets an apartment, right? We have some initial equilibrium, and here in the long run, you have 150 people who still get to rent the apartment at a lower price, the 500 instead of $800. Those 150 people absolutely win. The people who would otherwise have bought the apartment for a higher price, but can't obtain the apartment anymore, they can't get the product, they lose. So as far as consumers, some consumers win, right? And I say win, some consumers are better off because of the law, because they get this at a lower price, but some lose because they can't obtain the product at that price. What about producers? This one's a lot easier, right? Price drops from 800 to 500. It is unambiguous, producers are worse off.